Hi, welcome to the monthly market outlook of ICICI Prudential AMC for the month of June 2016. If you look at what has happened in the past 2 months or so, we've had pretty good news on the Indian front. The month of May has also seen indices go up by 4%. That's mainly led by two good news. One is on the GDP front, where the GDP came in much better than expected by the street. And second was, if you look at the corporate earnings as well, the corporate earnings after almost 12 to 13 quarters of negative disappointment have actually turned into a positive surprise. So the micro environment in terms of earnings has definitely improved, and that is also ably supported by the better GDP numbers. Our interactions with companies on the ground as well suggest that there is definite pickup of domestic activity. If we look at the globe, just the meeting which went, or the Fed FOMC minutes which came yesterday, it suggested that maybe in June we may not see a hike in Fed. At the same time, globally with crude prices going up and commodity prices stabilizing, the global macro picture looks stable today versus 3 months back. And hence we've seen the rally between February end and now, seeing a recovery in the markets from 6,800 to close to 8,200, 8,300 levels right now. What we recommend investors in terms of the equity markets is dynamic asset allocation funds. We also recommend large cap oriented funds, and most investors who normally prefer SIP as a beautiful investment medium should also look at SIP top-ups. If we look at what SIP top-ups can do, you can have additional percentage-wise increase in your SIP amount every year, or you can have a fixed amount in SIP every year. This helps you achieve your goal much faster. So please do have a look at SIP top-up as a feature for improving and increasing your wealth maximization over time. On the debt side, if you look at it, with a better expectation of monsoons, there is likelihood of yields cooling off further. The RBI stayed their rates right now, today as we speak, in the monetary policy. And we expect that once the monsoon is better and the interest rate transmission of the banks in terms of lower interest rates comes through over the next few months, we may see 1 or 2 more RBI rate cuts, which should help the bonds. For incremental investment, we are recommending medium-term, short to medium-term funds and dynamic duration bond funds, as the case may be. As on the longer end, right now, what will happen is the interest rate cycle may actually turn by the time the second or third year comes. Hence, we are moderating our view in terms of duration funds. We are no longer recommending longer duration funds. What we are recommending is short to medium duration funds. So with that, basically the clear conclusion is that India is in a good footing. If we look at the entire globe, Indian currency, Indian growth on GDP, Indian earnings growth, all look much better. And as such, from an FI investment point of view, India seems to be one of the better destinations on the equity side. If on the debt side, if you look at it also, FI investments continue to be strong because Indian currency is stable. The yields on Indian bond are higher than the bonds, the yields on bonds across the globe. So both on the debt and equity front, we see good fund flows coming up, which should ideally do augur well for the investors investing in debt and equity as of now. So we are positive on equity on a 3-year point of view. We are positive on short-term debt to medium-term debt on a 1-year point of view. And yes, we expect earnings to improve over next 2 to 3 years, which should ideally do well for the investors in terms of their investments in equities. With that, I wrap up the June monthly market outlook. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.